Have you ever noticed something strange about financial crises? They never feel familiar, even though they keep happening. Every time a market collapses, we call it unprecedented. Every crash is labeled once in a lifetime. Every bubble is said to be unique, and yet the story never changes. Boom, confidence, greed, denial, panic, collapse. From tulips in 1700s Holland, to Black Tuesday in 1929, to the housing crash of 2008, and even the speculative mania of crypto and meme stocks, the same pattern keeps repeating. Different assets, different generations, same outcome. And the uncomfortable truth is this: financial crises don't just happen to us. We help create them. I'm done. I want out. It's just money. 1637, 1797, 1819, 1837, 1901, 1929, 1937, 1974, 1987, 1992, 1997, 2000, and the cycle continues. Time and again, financial markets crash. And yet, we rarely stop to ask, why? For centuries, markets have risen and collapsed with frightening consistency. Entire systems built on confidence unravel in moments. Fortunes vanish, lives are disrupted, and every time, we ask the same question: how did this happen? To find the answer, we need to go back far before Wall Street, before banks, before central institutions. We need to go back to the Netherlands in the 1700s at the time. The Dutch were among the richest people on earth. They dominated global trade. Wealth flowed in from every corner of the world. But culturally, there was a contradiction. Most of the population followed Calvinism, a strict Protestant belief system that discouraged luxury, excess, and public displays of wealth. You could be rich, you just weren't allowed to look rich, so people found a loophole. Exotic flowers imported from the Ottoman Empire became symbols of status that didn't violate religious rules. They were beautiful, rare, acceptable. At first, tulips were simply collected. Then something subtle changed. People began to notice that prices kept rising, and once people believe something will be worth more tomorrow, they stop buying it for what it is and start buying it for what it might become. Soon, tulips weren't being traded as flowers anymore. They were being traded as promises. Contracts were created guaranteeing delivery of bulbs in the future at a fixed price. These contracts could be bought and sold before the flower even existed. This was one of the earliest forms of futures trading. Paper claims replaced physical value. At the peak, some tulip contracts were worth more than houses. But here's the important part: almost no one was actually exchanging tulips for homes. The speculation existed almost entirely on paper. People weren't investing in flowers, they were investing in belief. And belief works, until it doesn't. When enthusiasm faded, buyers disappeared, prices collapsed, confidence evaporated, the bubble burst. Not because tulips failed, but because belief failed. That distinction matters because it explains everything that follows. Fast forward to the early 20th century. The First World War had ended. The United States emerged economically dominant. Industry expanded rapidly. Technology improved. Production skyrocketed. The economy was growing and growth needed money, so people borrowed. Farmers took loans to expand land and buy equipment. Factories borrowed to increase output. Ordinary citizens used credit to buy radios, appliances, and automobiles. Debt became normal. And as more money flowed through the system, something else grew just as fast: optimism. People began investing in the stock market in record numbers. Prices climbed steadily. Confidence hardened into certainty. The market had never fallen this much before, so surely it never would. Banks noticed this confidence and saw opportunity. They began offering margin trading. With margin trading, investors didn't need the full price of a stock. They could put down 10% and borrow the rest. $10,000 could control $100,000 of stock. If prices went up, profits multiplied. But if prices fell, losses multiplied even faster. At first it worked beautifully. From 1922 to 1929, the Dow Jones more than doubled. People borrowed more. Banks lent more. Risk disappeared from conversation. No one wanted to imagine the downside. Because imagining risk meant slowing growth. And slowing growth meant being left behind. Then, in late 1929, prices started to wobble, not crash. Just wobble. But leverage turns small movements into disasters. Margin calls followed. Investors were demanded to repay loans immediately, but they couldn't, so they sold. Selling caused prices to fall further. This triggered more margin calls, which forced more selling, a self-feeding collapse. On October 29th, Black Tuesday, panic exploded. Markets plunged. Banks failed. Businesses shut down. By 1932, 1 in 4 Americans was unemployed. Half of U.S. banks collapsed. The Great Depression had begun. Once again, the asset wasn't the problem. Leverage was. Nearly a century later, humanity believed it had learned its lesson. Markets were regulated. Banks were supervised. Risk models were sophisticated. This time would be different. After the dot-com bubble burst in 2000, investors searched for something safer, something tangible, something real. Houses. Real estate felt solid, physical, permanent, but most people couldn't buy homes outright, so mortgages became the gateway. Banks lent aggressively, and instead of holding those mortgages, they bundled thousands of them together into mortgage-backed securities. These bundles were sold to investors. The logic was simple. If people always pay their mortgages, then this is safe. The demand exploded. Banks needed more mortgages, so standards fell. Subprime loans entered the system, mortgages with low introductory rates that later reset much higher. Borrowers focused on the early payments. They assumed they could refinance later. After all, housing prices only went up until they didn't. As interest rates rose, homeowners defaulted. Defaults weakened mortgage securities. Banks realized their safe assets were built on fragile assumptions. Housing prices fell. And suddenly, banks couldn't sell homes fast enough to recover losses. Major financial institutions collapsed in days. The global system froze. Governments stepped in to prevent total failure. Trillions vanished. Once again, the crisis wasn't caused by houses. It was caused by layered speculation built on belief. And now, look at the modern era. 2020-2021. Crypto surges, meme stocks explode. Digital assets skyrocket overnight. The language feels familiar. Early adopters. New paradigm. Old rules don't apply. Leverage returns. Trading becomes gamified. Social media amplifies success stories while hiding losses. Fear of missing out becomes more powerful than fear of losing everything. People don't invest because they understand the asset. They invest because others are getting rich. This is not ignorance. It's psychology. Humans are wired to follow crowds, especially during uncertainty, and most people don't understand financial systems deeply. They don't know how leverage works. They don't know how risk compounds. They only know the outcome they hope for, and when crashes happen, the cost isn't theoretical. It's pensions, savings, education, retirement, future security. People who never speculated still suffer. Because financial systems don't collapse in isolation, they collapse outward. So who is to blame? Banks, influencers, institutions? Partially, but the deeper answer is harder to accept. Crises happen when collective belief replaces caution, when growth is assumed, when risk is ignored, when history is dismissed. The real cause of every financial crisis is not a flower, not a stock, not a house, not a coin. It is collective belief amplified by leverage and protected by denial. Belief that growth is endless. Belief that risk can be engineered away. Belief that this time is different. History doesn't repeat itself because we forget. It repeats because we choose not to see. And maybe understanding that is the only way the cycle ever breaks.